gonna get started.
Is this your bed?
Where'd everybody go?
She went down to go get plates for bagels, I guess.
Oh, okay. So we're gonna get rocking here. How many people we have at home? Let's see. Participants, we got 7 at home and more will join. Jamie, why don't you jump up here too? Yeah. Yep, great. We're gonna do kind of a whole panel here.
Gonna wait.
And there we go. Justin, will you move the camera?
Yeah. We did our notes from yesterday.
All right, we're getting started, everybody. You can just move the whole tripod. There we go. That's fine.
Is that
Yep, we're good here. We're good here.
Okay, cool.
Okay. All right, we're gonna get rolling. I don't know where Jackie might be. We're gonna get rocking here. So for those at home, you guys can hear me? Let's see, getting my volume up. Okay.
So I do a lot of focusing in that area.
Okay, awesome.
Okay.
Most of my American stuff is
Awesome.
All right. So for those at home, can you guys hear me? I'm just unmuting you right now.
I can hear you.
Got it.
I can hear you too.
Perfect. All right. There we go. Come on up.
Oh, yeah.
So we got a bunch of people watching at home, people live here. So I'm going to get started with this. I'm going to moderate this panel with a list of questions. We're going to be talking about mortgages. What I really want to do today is just kind of do a deeper dive into the mortgage side of the industry and talk about the things that agents should really know, the nitty-gritty about what you guys do, how mortgages work, how people, approach you guys, what the first steps are. So we're going to go through a list of questions. And you guys can ask questions too and at home. So my first question, and I'll sort of just go around and ask specific questions, or maybe all 3 of you guys can give one particular question. So the first question I have for you guys is, what would you say some of the greatest misconceptions that you guys see from consumers when it comes to the mortgage industry or process?
I think some people think that it takes more effort than it actually does. But if you get somebody in your corner working for you, I just think people can sometimes get overwhelmed or think that it's very difficult, or if they're looking at one lender, it's very difficult to look at another.
So you think it's anxiety?
Yeah, I think so.
Jamie?
So I think the pressure of online nowadays is becoming more and more, or it's creating a perception that all you need to do is take an application for 5 minutes on the phone next day. So that perception is becoming more common from a first-time buyer, usually from your younger people that have not been in the market very long. People that have both purchased homes in the past obviously know there's a lot more to it. But when somebody comes to the table and they want to write an offer that same day, they think that I'll just use the Quicken Loans, that 7-minute approval all they need.
So like 7-minute apps?
That's about it. There you go. 7-minute app, 7-minute approval, about the same, results.
Jackie?
I have to agree, it's the process, and it's very cyclical with the millennials. Same thing, Rocket Mortgage, click a button. It's the relationship in building is a lot tougher with that group. So we actually have a beta group that we have been testing the no doc process.
1 second. Hey guys, at home, if you can mute yourself until you're going to talk, because we can hear a lot of feedback. Thank you.
So we actually have a beta group right now that we have been up and running. It's going very well. They're 2 months. It's no doc, and it's because the market is changing and the millennials are less receptive to giving information and spending the time that you need to do the application up front correctly. So we can access W-2s, bank statements, everything for them.
Gotcha. So are you finding, a follow-up to that, are you finding that the way, 'cause people obviously aren't getting less mortgages, but the way that they're coming into the marketplace and the way that they're shopping for mortgages has changed, much
Yes.
like they don't go into Blockbuster Video anymore to rent a movie. They, will go online and order it, right? So Blockbuster might have been a medium of exchange back then. That has went by the wayside. New medium of exchange. Are you seeing that same process unfolding in the mortgage industry?
Absolutely. Absolutely.
And Jamie, you guys agree too?
Oh, yeah. Yep.
So the expectation for more instant gratification, more, I want access to information without having to, go through the relationship building, just give me access to info.
Yep.
And I want this to streamline and be easy. Yep.
Quick.
That's, and you're finding that among a wider range of demographic, not just millennial, or is it more first-time home buyer millennial?
I'm seeing it more personally first-time home millennials, because again, that's just how they're buying. They click a button and they have shoes at their door the next day. That relationship piece is kind of missing. So.
So are we expecting an Uber mortgage one day? That they
Yes.
press a button and then somebody drives up to their house
Yeah.
and gives them a mortgage? Yeah.
Here you go.
Okay, so next question with misconceptions. What misconceptions are you finding from the real estate community, from agents? What do you find there? We'll start with Justin.
That there's difficulty in some types of programs, like, rehab loans and things like that, at a certain level of anxiety, again.
Sure.
those types of things.
And just sort of set their ways of thought process and not willing to explore.
Right, or, I just think that it comes from just not a, no offense, just not an overall understanding of it.
Well, one of the reasons we're doing this panel today is because, people shy away. I feel in real estate, they shy away from financing because they think that's not my job. I don't need to really know financing because that's not what I do. I just sell the house and write the purchase agreement. I disagree with that. I think the greater understanding you have with financing, the better of an agent you are, and the more you can interpret people's misconceptions and thought process and put them in the right direction.
Right.
So same question.
Yeah, so I think a lot of agents struggle with vetting the buyers when they start working with them. They're so afraid, like you just said, to bring up anything to do beyond are you pre-approved on the findings. They're afraid to bring that question up because they don't want to tarnish that relationship. When, as you said, in reality, it's completely the opposite. They need to vet them a little bit because when you get into the multiples, which is pretty much what we see almost in every case, the better vetting you did on the early end is going to give you a much better chance of winning when obviously you're speaking to a seller. So again, you and I have had this conversation a lot, and that's why we're all here is to make sure you understand the questions to ask whether we're the lender or not. So again, in the end, if you do get into a situation of multiples, you shine versus your average agent out there that doesn't really put any effort towards it. That's right.
Yep.
Yeah.
Misconceptions, real estate community.
Just setting the expectations on closing. I think that's probably been my biggest challenge in the last year because.
Posting that letter within a week and a half, right?
Yes.
Yeah.
Yes, just
Written statement letter.
explaining TRID and all of those regulations. It's, we do, Marketplace does have an on-time guarantee. If we miss the closing date, we will pay the mortgage payment, first mortgage payment for the borrowers up to $1,500, and the seller will get $5,000. But we also have to be realistic. We can't close a loan in 2 weeks with TRID. So
Yeah.
it's
Gotcha.
just setting the right expectations so that there's not disappointment in the buyer or sellers.
Gotcha. So with the real estate community, do you find, with the consumers, do you find that there's a common mistrust between consumer and lending institution? We had a terrible crash, obviously, years ago, where the mortgage industry was black. There's a black eye in the mortgage industry. There's a black eye in the real estate industry, right? Everybody involved, there's a black eye and mistrust. And even probably before that, do you find that there's still a mistrust today? Or do you find that that's easing to a point?
I really am not.
I think sometimes people will commonly have mistrust with a lender or any kind of bank.
Well, yeah,
They're
they're
just
dealing with their money.
naturally, exactly. So I see it a little bit, but if you break down the barrier and talk to them like they're normal,
Well, how do you, that's a good follow-up to that. How would you break down the barrier? They walk into your office, obviously your fees might be different than somebody else's, you're dealing with their money, there could be a barrier of trust there. So how do you break that down? Because their client being sent to you, you have to be that cohesive glue to keep that together, right? If you don't do well with that consumer, it's a bad mark on them, right? So how do you bridge that gap?
Well, yeah, that's something, oh, yeah.
So, and you've brought this up, our jobs are not salesmen. Our jobs truly start more as a teacher.
Yeah.
So a lot of, I'm not gonna use names of big banks, but I'm sure you'll agree, a lot of times with these bigger companies, they need to do so much volume that they lose sight of the time that it takes to educate people on they're just application, get it to pre-approved, get it to under contract. So people kind of just everything goes right over their head. They have no idea what they actually just did. So when we start dealing with people that have already been pre-approved and actually slowing the cart down and actually, let's take a little time to understand what you actually, have done already and what to expect going forward. I think people truly appreciate that education piece. And then you don't really have to worry about them turning around, picking up the phone and calling somebody else. And real estate agents, it helps you because, again, they're not asking you those same questions. Like, what type of loan did I qualify for? Why am I putting this much money down? What is PMI? Who is Fannie Mae? What role do they play? When you take that time to educate them at the very beginning, it really makes the process much easier for you and us. But I see that still as today, this day, probably one of the biggest advantages, for our end versus the online companies.
Sure.
You do have sure.
So this is another follow-up to that. So for Jackie, if an agent, right, it's one of your agent, they're a referral partner, how important do you think it is, or how do you view it, to make sure that you're helping convert that lead, that potential borrower, for that agent, to keep that in-house, so they don't go somewhere else?
Oh, that's huge.
And the reason I bring that up, just to finish up, is because if they go somewhere else, it's a possibility that lender then can try to refer that client to a different realtor. They're going to try to hook them up. So how important do you think that is, and how far do you guys really fight to keep that relationship in-house?
Well, that's why we're here. I mean, it's a partnership, like we talked about. We're here to help you guys, feel comfortable giving us your client, and that you have 100% peace of mind that we're going to do our job and we're going to do it right. And to Jason's, Jamie,
Yeah,
sorry.
it's fine.
I got the J right. To your
All
point,
J's.
yeah. To your point, setting that expectation up front, but the customer service piece is huge. Even with the millennials, if you have to push them a little bit and, get them on the phone instead of texting or emailing, everything that you can do along the lines to give them great customer service. They're going to tell people, and they're going to refer us.
So here's another really good question. When I was in production, I saw this a lot. What would happen is you have a buyer that they were told, you do not qualify for a conventional loan, or you do not qualify for an FHA. You can't get FHA or Fannie Mae or whoever will not approve you. Now, in reality, that wasn't always the case. That lender, that actual mortgage company had an overlay that wouldn't approve. But Fannie Mae, with a different company, perhaps would have. So how do you handle that? Perhaps if your company can't do the loan, what's your messaging then to the agent? Because they don't want to go, I hate to tell the agent, because then they'll go somewhere else. They think we can't do loans. How do you handle that personally when your company can't do the loan, but maybe somebody else can? So Jamie, I'll start with you.
Yeah, so if it truly comes down to where it's just something AMIC can absolutely not do, usually we have a referral partner that we can send it to. The unique situation, I guess, that you come across maybe is when you're dealing with like maybe a mixed house or mixed, where you got some commercial on the base, something at the top. Yes, there you go. So, but before we ever usually get that far, we've already explained that, because usually at the pre-approval process, you pretty much can vet the client, figure that part out. But if there's truly, I'm just trying to think of scenarios, if we just absolutely can't do it,
Well, for example, let's say there's a minimum credit score, and for FHA, for example, that your company has, but somebody else would go down to a 580 or something.
yeah.
Are you comfortable, or how do you have that conversation with both the buyer
Well,
and the
like
agent.
you already kind of brought it up, whether this is Fannie, Freddie, Amic, whose rule is it that's disqualifying? I mean, I would flat out say it. This is our guideline. It's possible there's, mortgage company in, Texas that will do it. The problem is there's so many different companies out there that there's probably a solution somewhere. It's just whether
Right.
it's realistic, et cetera. But I mean, like Marketplace, I think a lot of lenders that are set up like our companies have the broker channels, but there truly is something that's not in our wheelhouse for ourselves. Usually there's a option. That's right.
Same question to you.
So I absolutely would want you guys to know if we had some overlay, because I don't want you to run into it again. But again, we have 17 investors. Marketplace has a niche for that kind of out of the box stuff, or things like that. So we do, correspond that we can send it out. The downside to that is it might take an extra week to close the loan.
So let's for those that don't know the difference between correspondent and sending, can you guys kind of touch base on the difference on those and what it means internally to get the loan done?
So we have most investors where we can just underwrite the loan in-house. Our underwriters are approved and there's no issues with that. But we have certain correspondent lenders, again, that we use for some really oddball niche product. A lot of the mixed use, like we brought up, a lot of the unwarrantable condos, things like that, where we don't have delegated underwriting. So we can get the file done, but we have to send it out to their underwriters. And so it takes an extra 3 to 5 days, business days, because we have to, everything's electronic now, things are quick, but they have their process and we got to get in line, and I don't have the ability to push it through as quick. So it typically will take an extra 3 to 5 days. We'll send it out to be underwritten and it will come back. So it's kind of the difference.
Anything to add to that?
No, I mean, again, our companies are very similar as far as how it's set up that way. So, when you're dealing with your own in-house underwriters, you have a lot more control. Plus, you already have a good understanding. You're all on the same team. You want to get it to the finish line because if we shine, they shine, and vice versa. So when you do broker it out, you are now dealing with a third party that their only goal is to look at their company and their company's policies. That's why you have an extra time frame to deal with. But the nice thing is, for most of those broker channels, you can do that on the front end versus waiting until you're already 20 days into the contract.
So the difference with corresponding and broker lender. So obviously part of it is going to be you're going to control the underwriting in-house,
Correct.
right? Another part of it is you're typically going to fund the loan
Correct.
in-house in your own warehouse or credit line. Versus brokers, your money doesn't touch the transaction, correct? So you're having control of the finance, you're having control of the underwriting, and you're having control of the money that's funding it, and then you're selling it off to the investor after closing.
Transferring the service rights. Yeah.
Right, where you never actually own the loan at all when you're brokering it.
Correct.
As a correspondent lender, there is a period of time, it was your money that funded it, but your intention is always going to be to sell that off to a different investor,
Yes.
correct?
Yep.
And the investor could be a servicer, right? Somebody that's going to actually service the loan, and that's really what we're talking about normally. Or they could own the loan, it could be a private investor or Fannie Freddie Direct, is that a true statement, right? Yeah. So let's get to the process of application. We talked about application a little bit earlier. This is something that I think people still kind of struggle with because now there's online application, and I think Jamie, you brought it up too, that people they think they fill out an application and they're ready to go to shop for mortgage. Well, what's actually in the application? What's the application form called, Justin?
Well, any industry we call it a 1003, but to the customer, yeah. To
Yep.
the customer.
So when you hear that, yes, mortgage application to the customer, right? But in the industry, we hear the 1003. If you filled out the 1003, right?
Right.
But what is that? What's in that 1003? What's required? What completes a mortgage application?
So income information, personal information, social security number, current address, past 2 years of employment and residence.
Okay.
Is pretty much it. I mean, yeah.
So they write this stuff, but then they also have to supply the documents back to the state now.
I think that's Chris.
Okay, so anyway, they have to supply the documents, so they don't get to just state what their income is anymore. And we talked about mistrust in the industry, that was part of the mistrust in the past, right? You could just put people into bad loans that made no sense for them because they create a higher yield for themselves. I mean, no income, no asset, just, yeah, you can have a hard people get a loan, right? And then we know what happened. But today, you've got to back up all the statements around that 1003. So can you talk a little bit what that looks like in terms of once I fill my application, I'll give it to you. When do I actually send those documents in? And what do you guys do to verify those documents to make sure they're accurate?
We have an Amex guarantee. So in an ideal situation, what we would like to do is we'd like to get the application up front and get all the documents up front.
Guys, if you're at home, please mute yourself. We can still hear you unless you're talking. You're welcome to join in the conversation, but please mute until you're ready to talk. Thank you.
So yeah, in an ideal situation, what we'd like to do is get everything up front, all of the documents that are required. Then what we do, again, is we have a pre-underwritten guarantee. So we will actually submit everything over to an actual live underwriter who looks at everything,
As
verifies.
opposed to one that's been passed away for a while.
Well,
Yeah.
or instead of, you know, whoever going through it and thinking and assuming it's okay.
Yeah.
You know, a real underwriter, because they're the ones that, you know,
Make the decision.
exactly.
Yep.
So, and then they come back with an approval, which comes with a couple of different guarantees. You know where you're at, you know you can afford, and the file's locked and loaded. That comes along with a closing guarantee where we will pay the buyer and seller $5,000 if we don't close on our end on time. So that's kind of how that process works, if that answers the question.
Okay, so with that piece, now you are saying you're sending it to an underwriter. At what point, because we hear things about desktop underwriter or automated
sure.
underwriter. So at what point, you know, do you run it through an automated system? And then you're going, okay, I got an approval here, but we still need with this guarantee programs, right? Because you both have guarantees. You guys both have to have it physically touched by a human being before that guarantee is granted.
For us, yes.
For us, yes, as well. We
Okay.
have, I don't know if you can see this or not. So we have actually 3 stages for the pre-approval. So we have a pre-qualification,
Yep.
a pre-approval, and a full approval. So the pre-qualification, we would just take the application, collect no docs, but we will pull credit. We'll run it through DU, DO, whatever you want to call it. We'll get a decision. We'll, you know, issue a pre-qualification. We can do that in minutes. We can go to the next step and do a pre-approval, which is the same process, but we collect documents. We still run it through DU, DO. We give you a pre-approval. And then if you want a full approval, we can do it within 5 days. So it's the full application, the full documents. It goes to the underwriter. The underwriter signs off on everything that's in the file, the W-2s, pay stubs, bank statements, whatever is in the file, so that when it comes back around again, hopefully it's just the appraisal, the title work, purchase agreement, and then you're good to go.
So another great, and it's similar for you guys, right? So that, yeah. So one other thing I wanted to bring up is we hear about, you know, the written statements, because obviously in the purchase agreements we have that date that we can select. Written statement needs to be done by X date. Now we talk about unrealistic expectations, and from our side of it on the file auditing, I'm like, you guys thought you could get this thing done in 10 days? Probably not realistic, right? So you got to put realistic timeframes in there. But here's what big misconception that I see of what constitutes a written statement. This is one that has gone in circles over and over and over again. So from the technical perspective, a written statement basically is not much more than an approval letter, but after the appraisal's been done, saying we have an acceptable appraisal and here is the conditions left to close. That's really what it spells out in the purchase agreement. What kind of pushback or what kind of misconceptions or what are people asking you for in terms of a written statement? And Jamie, I think we've had this conversation before, so let's start with you.
So it really obviously comes out of the seller. What are they asking for? Because it's always their, what their, idea of a commitment letter is. That's where it varies. Like you said, and what I explained to them, the definition of a commitment letter is I have final underwriting conditions as well as an actual appraisal in hand. And that's what I'm left to submit to the underwriter. Some will come back and say, well, that's nothing more than a glorified approval. And I'll say, well, the other option is clear to close. So obviously it's not a clear to close, that's why it's a commitment. And assuming the appraisal is back, that is the one big piece that none of us have a ton of control over. So that's why once we've received that value comes back, we do say, okay, based on this value, assuming an underwriter accepts the appraisal, it is a commitment to lend. And in most situations, when it comes to the underwriting conditions, these are minor things that are left. Obviously, I'm not going to explain to a seller that we're committed, we're ready to close if there's a big deal breaker still hanging out there. And what we have found in these commitments, one time about 2 months ago, some sellers are trying to use that as a way to get out. So you have to be very careful, what you say and when you put that timeline on there, because I forget the scenario, but we had that one seller leveraged that.
And it's another
reason to get out of the transaction.
It's another reason why you have to be careful on what date you put on there, because if you don't deliver that written statement on that date, the seller can declare that contract canceled. They can't keep your earnest money at that point, but they can say, we want a cancellation, here's your earnest money back. Mm-hmm. It's a declaratory cancellation, not a curable one. You don't just get to give them the written statement 2 days later and say, oh, we're fine now. If they declare it canceled, they have the right to do that. So be very careful on the date you put in there. I know you want to win the multiple offer, but you could be setting yourself up for a future failure, because if they have backup offer and other interest.
Just about to say backup offers.
Yes, that's where
higher value.
That's what it'll come from. So same question to you. So what?
Same.
Okay.
Same answer.
Gotcha.
Yeah.
What I wanted to point out too, because this is very important, and Jamie was saying the words, I think you hear the word all the time, is commitment letter. And the written statement is not a commitment letter. They removed the language of commitment letter from the purchase agreement years ago, because a commitment letter truly is a commitment to lend if you finish these, couple items, right? So a written statement basically is a glorified approval letter saying that we've done underwriting up to this point and we have the appraisal back. So it's not a commitment to lend, it's not a clear to close. It really is, the appraisal's done, here's the outstanding stuff, and if we have that, we should be good. So, to understand that concept is pretty big, because what you're gonna hear from realtors, especially listing agents, this is not a commitment letter. One, they never was intended to be. That's not what the contract says. So, that being said, let's talk about conditions to close. We hear about loan conditions. Let's talk about common ones. What would you say common loan conditions are to close? We'll start with Justin on that.
So if we, in a scenario where we collect documents up front, and then depending on how long it takes the customer to find a home, there can be just a gap that you need to close in the way of pay stubs or bank statements or things like that.
So the next bank statement or the current pay stubs are two very common conditions to close, correct?
For sure. Yep.
Any other thing beyond that?
Yep, so obviously, we all know this, somebody goes under contract. One of the very next things they have to do is pay for the earnest money. And, obviously, so we've already pre-approved it, fully under-approved, doesn't matter what type of approval you come up with. So it's very important for all of us to be on the same page with where that earnest money is coming from. Because again, in many cases, we don't find out until it's already happened. So one of the most common things I see is a condition coming. Where did the earnest money actually come from? And I find that it's all over the place. It could be grandma all of a sudden just handed them $2,000 in cash. So that's one of the things that we see always.
Yes,
after a contract accepted, issues with earnest money approval or verifying the earnest money.
Unverifiable.
Even if they have the funds, some way or another, they come up with something else. Or the other thing is obviously what they've done on credit since. A lot of that inquiries, to just different various things. So.
And Jackie, speaking of Jamie's point with credit, how soon, let's say you pull their credit today, they get on a purchase agreement in a week, they close in a month after that. How soon before closing are you going to do another credit pull? And how important is that to be conscious of as a consumer and an agent?
So we don't re-pull credit.
You don't?
No.
Okay.
So
Because it's good for
90 days.
90 days.
Yeah.
Yep.
My biggest issue that I run into, because it's such a purchase market right now, and it's typically the younger group, assets to close are always coming in at the last minute, because they're saving, you know, they need every penny. So it's typically verifying assets to close is what I'm scrambling with at the last minute, just because they need that, all that time.
Yes. So let's and thank you. So let's jump to the big elephant in the room, because we're talking about assets to close. Today we have a housing market with very little affordability. I mean, it's getting harder and harder to afford a home. Never before have we had, you know, people with such high debt and low savings. You know, so when you have high home values, no savings, high debt, you know, mortgages are becoming more flexible, obviously, than they were 5 years ago, you know, approval guidelines, but you still have cash flow issues, you know, so down payment assistance and, you know, things of that nature. You know, lenders don't commonly make a lot of money on those programs. We all know it. Realtors know it. You guys know it. But when you find a borrower that needs payment assistance, what do you do with that? You know, I mean, they've got the credit, they've got the provability, but they don't have the cash. They have two options. They can either do a down payment assistance loan or wait and save up, right? But if they want to move now, their lease is over in, you know, 60 days and they don't want to rent for a year. What do we do with that buyer? We'll start with Jamie, because Jamie loves these.
Well,
I know they're-
look, I mean, at the end of the day, guys, it comes down to us educating them and then they making the decision. And, you know, down payment assistance is one of those pieces that has to be a part of that conversation, making sure they understand the pros and the cons, because there is obviously cons to it as well. But, you know, besides, you know, down payment assistance comes from pretty much two main locations. You've got Minnesota itself through Minnesota Housing, and then you've got a lot of the local programs through the counties and cities. So depending on where they're buying, if it's just a generic buyer, I immediately dive into Minnesota Housing, because that's the one that goes everywhere and anywhere. And nowadays, it's not that difficult to qualify for. It used to be much more complicated years ago. Now, the benefit to what it provides, you know, that's where, again, you have to explain that. There's no, unfortunately, free lunches for the most part anymore, meaning the money does not get forgiven. It used to, meaning after they stayed in the house for so many years, it would go away. That's not as much the case anymore with most of these programs. So when you explain that to a lot of people, you know, a lot of times they kind of look at it as, well, why would I do that?
So it's not a forgivable second the way it used to be.
Not as much anymore, no, it's very rare. Some of the
And they're
county city
charging
programs.
fees.
Yeah, so you got
They
additional
charge a
costs. And a lot of sellers look down on that.
They do.
You know, they don't like the fact that you're going with down payment assistance. So when you're competing, that can be a play decision in it.
It could. And then for you, same question.
So same answer, but one thing that's extremely important, they have to go through and get an education and a certificate. And the thing that I see is that borrower will come to a lender, get the pre-approval, and the county only offers the classes every so many weeks. And they have to go through several different classes to get the certification. So they may rush out, come to you with this letter, hey, we're pre-approved. You guys go find a house, get a closing date, and then they don't realize that, you know, it takes them a month and a half because they're working full time to get through all these classes to get the licensing or the certificate that they need to get the funds. So if you start to hear people talk about, hey, I need some half assistance, down payment assistance, whatever it is, educate them that there is a process to it, and it can be lengthy sometimes, and it can slow down your closing date and things like that. And then the other thing I would want to bring up is USDA. You know, it's a program we kind of forget about, but there are quite a few properties that are eligible, and they can still do 100% financing. So, and it's great for a first-time home buyer. You know, like New Prague is just a perfect example. There are so many properties down there that are USDA approved, and people just don't think of that loan.
So, and let's also touch on what Jamie was talking about, because it doesn't have the same stigma that the down payment assistance does.
Right.
With USDA.
And it's a great rate.
It is, yeah. And there's benefits. There's a lot of extra
Yeah.
benefits to it, right?
Yep.
But we always assume that means way out in the country, you know, and we make those assumptions and
Yes.
we forget to check, you know, if the property would qualify.
Yeah.
So I think it's very important that, you know, if you're kind of on the outskirts at all, even like Forest Lake in my side of town on the northeast side,
Yeah.
Forest Lake doesn't seem that far in the country, but that's right on the line. Like you literally could be in a USDA zone on one side of the highway or the other.
Yeah.
So, so great answer there. Now, let's also think about, you know, what we heard about yesterday from TurnScore. You know, credit is still a pretty big issue. There's still a lot of people that have credit damage. Now, are you seeing, and obviously things have gotten more flexible with bankruptcies and foreclosures and things of that nature, but can you kind of touch on the guidelines? You know, if I had a bankruptcy discharged, you know, tomorrow, when can I buy a house? If I had a foreclosure tomorrow, when can I buy a house? When can I actually be approved again for a mortgage, and what does that look like? Justin, we'll start with you.
So it's 2 years, for a bankruptcy.
From discharge date, correct, okay? And we're talking chapter 7, not 13. We're talking strictly chapter 7, right? And 13, I mean, they've got that payment plan. So what is it? We'll talk about what that looks like too. But on chapter 7, we're talking 2 years. Okay, so at 2 years after, they can purchase a conventional loan, VA, FHA. So on everything else, we're kind of SOL until what period?
4 years.
4 years. Okay, gotcha. Foreclosure, Jamie.
So foreclosures in general are anywhere from 3 to 7 years. Again, to a client, you know, the first question is, how long do I have to wait? We don't have to get into technicalities on what type of loan, like you said, because then they just want to qualify.
Right.
But in general, 3 years is kind of that magic number. There is always the potential to go less than that, but you know, it had to have been caused due to like a major illness, something that really happened in their life that was totally unexpected. So the general rule of thumb for Fannie, Freddie, FHA is 3 years on for FHA financing. So,
Okay, so
and
beyond
that is
that,
from the sheriff's sale.
and this also brings up another intricacy because now with equity coming back into the market again, you're finding people that are able to sell and redeem foreclosures. We're seeing that from time to time. If they redeem it, meaning that it never went through the full foreclosure repossession process, it went through the sheriff's sale, but it never was repossessed by the bank. Does that affect their ability for future finance differently than had it went through full foreclosure?
Yeah, they look at it a little bit differently, more like a deed in lieu
Okay,
versus an actual foreclosure.
which would,
So, let's see here. I have to think of my brain now because I don't see these too often.
But you still have the potential issue that they've been so late on the mortgage.
Yeah, I
So
mean,
you
it's-
still have that
the
issue.
1 year late, yeah.
Yeah, so that,
So minimum, if I remember right, it's at least 1 year because you have to have the one solid year of good payment history.
right,
But that's only if other circumstances apply, if I remember right.
That's right. I mean,
More case.
that's so
Yeah.
rare, I'll be honest. I probably haven't seen one of those in years.
We had one in the office, $100,000 in equity on a redemption. Couldn't believe that happened. Just happened recently. So we are seeing them from time to time. And obviously homeowners aren't always really geeked to go back and buy houses after they just went through this massive problem. But, you know, I have a feeling that as the market shifts and things again, we may see it.
Yeah.
Because as property gets more affordable, perhaps, you know, people that went through it last year may resurface. That's why I brought it out.
Sure.
So another thing on this, so chapter 13, do we see much with chapter 13 and how that affects mortgage approval?
Yep.
Let's go, Jackie.
so discharge date is the issue there. So you get into a chapter 13, they have a payment plan. So payments have to be made on time, and we go off of when that last payment was made. So that confuses a lot of people. So,
The last payment, so all the debt's discharged at
Yes.
that point?
yeah,
That's a difference, right? Because with the chapter 7 discharge date means once they've slammed the gavel down and they approve it and they file it, that's discharge, right?
correct,
Where chapter 13 isn't truly discharged till the debt's dealt with.
right.
Yep.
Yeah, so sadly, the people are trying to do the right thing in a chapter 13 and pay the creditors back on a payment plan, and they're kind of getting penalized because they don't really get to re-establish credit until that last payment's made versus a chapter 7. That debt is just gone, they don't pay it back, and the creditors are out that money. But they can move on a lot quicker. we do have a credit rescore. We were kind of talking about credit a couple minutes ago. So when we pull credit, let's say, you know, if they're a 500 credit score, we have, and I'm sure you guys have
Oh,
the
so you
same
pull
thing.
Justin's credit.
I didn't know this was gonna come up.
Yeah. So they'll actually walk us through specifically, tell your borrower to do this to this account, and it'll raise your points 8 points. You know, so we can, you know, collectively sit with them and counsel them and tell them, hey, do this, this, this. Come back to me, you know, in 30 days, we'll re-pull and your score should be this and we can get going.
So Marketplace uses credit counseling or slight credit repair program, if you want to call it that. You guys use iQualifier.
It's the same thing, actually. I think it's through Credit Plus.
Yeah,
It's what we
same
all
thing.
call rapid rescores.
Right. So, but beyond that, let's say at what point, what's the tipping point? You pull the credit and you say, this is probably on the line to maybe do a traditional credit repair. And the second part of that question would be, you know, what's your follow-up process to keep them in your funnel? Because that credit repair process can pull people away. I mean, the realtor's going, I don't really want to follow up. You know, I don't know how to follow up. These people might be months out. Do I call them every week? Do I call them once a month? What's my involvement here? Really, at this point, it's less realtor, more lender. But what do you do to keep them in the funnel to make sure they're not going to other realtors, to make sure you're on top of things with the credit repair and how you're involving realtors? So long drawn out question there, but kind of tell me the process.
So obviously, where do we go rapid rescore? Where do we go to credit restoration? That fine line. For our world, typically I like to try to get them to a 620 score or better. If I get them to a 620 score, they're pretty much going to qualify for pretty much almost any loan out there, with the exception of, well, even conventional technically to qualify, but whether it makes sense or not. So that's kind of the barrier that at least I look at. If I can get them to a 620 on a rapid rescore, which can happen as soon as a week, then we move forward that direction, assuming they have the funding. Because usually it involves paying down some debt and some credit cards.
Sure.
If we just don't see that happening, usually there's maybe a lack of credit, or they just got so many collections and just stuff that's just sitting out there that's just, no matter what, going to keep their scores low. That's when we get credit restoration involved immediately. Because now we're looking at a bigger picture of more likely 3 to 6 months. The follow-up, so obviously that's the key. So once they've made that payment, so you've gone through the conversation, they love you, they think this is the greatest thing. Really the next key thing that we all watch out for is it's $300, as she said yesterday. Once they've made that payment, or at least got on a payment plan, we know they're serious. This is something they really want to do. They're not just talking. We do a 45-day touch, because what happens is, so once they've signed up and we've confirmed, usually they have to establish some creditors, some secured accounts, secured credit cards, that is. They don't maybe qualify for an actual one. So at least our touch is, once they've opened up those secured credit cards, then I put a 45-day follow-up, because guess what's happening? They're doing their first round of disputes. And I know we kind of touched base on that, but in short, they're trying to remove old information. Now, the buyer obviously has the ability to track that. The agent as well can track that. But like you said, the agent's off. You guys are off looking at the next client, waiting for them until they get in that situation. So we do our 45-day touch. That 45-day communication then gets sent to the agent.
So back in the old days when I was in production, I always would have a set time pretty much every week that I would call my lender and talk about each buyer, whether it's a buyer that we're working with hot and heavy right now or something down the line. In fact, I used to call you when we were working together and like, here's our 4 people, where is this at, right?
Yeah.
So, do you see agents still doing that with you in this sort of tech-driven, automated world? Are you still, seeing people calling you on a weekly basis, going over everybody, make sure that things are not, getting missed? I'll let Jackie start with that one.
So we have milestones. We use Encompass for our CRM or our platform. So you do get milestones emails sent out to you for every change and process that the loan is going through. But yeah, we still do pipeline reviews.
Okay.
We have, it's really a personal preference. Some people want, hey, every Monday let's talk and let's just see where we're at. Other people don't want it. It's really a personal preference, whatever you want to do, and you can just communicate that to me, and I'll get that set up. And
I think it's a lost art. Communication in the industry now is becoming a lost art.
It is.
It really is. Okay, so that being said, now we're talking about how to engage the agent with the credit repair process, but this is where it gets a little tricky, is confidentiality.
Right.
Right? So how do you bridge that gap to be able to say, Derek, man, I know it's your buddy from high school, but this guy's credit is like in the tank. I mean, how do you have that conversation, or how do you bridge that gap without violating any confidentiality laws?
So I go right to the consumer. They can have that conversation with you. We can tell you there's issues with credit. They can come to you and explain more in detail, what they want to disclose. That because you're as an agent, really all you care about is do you qualify, and if not, when. So that's really the only information that you need to, be aware of. We don't need to give you, because like you said, you're not supposed to know it anyway, so we don't want to put you in that position where you have to say something that you shouldn't know, because now we can both be in trouble because of it, whether it's a friend or a past client, doesn't matter. But for us, again, it comes back to the very beginning, educate. When you explain to consumers why maybe they don't qualify now and what they need to do, they can then, if they choose to, volunteer that information over.
Gotcha. So there's a little bit of an art form to doing that, right?
Well, and you say it's an art form, but I always just say, gosh, it's just common sense stuff. I mean, and at the end of the day, this is what locks in your clients for both of us. When you really take that time, you don't have to worry about them just turning the next person down the street. So they understand why they don't qualify, and that the guidelines are maybe from a Fannie or Freddie, not an overlay.
Right. Next question. Student loans. We know there's been some changes in student loan debt in the last few years and how that gets looked at, but are you seeing student loans be a factor now in approval? Are you seeing it more commonly with now millennials and first-time home buyers overtaking the buyer market by storm? They're the largest demographic of buyers. So Justin.
Oh, yeah. Yeah, you got to be careful. It's always good to, like what we've been talking about, as it begins, so it shall go. So if you vet the file correctly up front and you take a look at their credit profile, you're going to want to take a look at this, student loans and figure out what you need to do.
Are you seeing it commonly? Is it something you see on a lot of applications, or are you running across it? Okay.
Yeah, I think so.
Jackie, you?
I'm seeing a ton, and my biggest challenge is that the way that they report student loans. So the consumer might be making one payment on a loan on 5 different loans that have been bundled together, but it doesn't show up on the credit report that way. And so it does take a little bit of work to figure out which loan is which. Sometimes they're getting, counting twice. There's a lot of duplicates in the student loan disclosures on a credit report. So it is important to, if I know in the application that they've got student loans right away, I'll say, listen, sometimes we have challenges when these get reported, and they understand because they seem to have had issues with the servicing. So I'll just sometimes ask them to actually give me their statements so that I can cross-reference account numbers and things like that. It's just a little additional information like to collect up front just to give clarity on the file. But there's, still a lot of confusion with the servicing piece.
There is. Speaking of servicing, one point I want to just kind of clear up for everybody is really how the mortgage wheel really works, because you hear things like, Amaker Marketplace, and you hear the word investor, and you hear the word servicer, and you hear the word Fannie and Freddie. Can you kind of, explain how those pieces work in both the primary and the secondary mortgage market? Jamie, we'll start with you.
Yeah, so again, this is a great conversation to have with the buyer, because this is what helps us explain why they want to use companies like ours versus maybe a broker or a bank themselves. So ultimately, the rules in our industry come from, for the most part, Fannie or Freddie, because guess what? They're the ones that are truly funding the money behind the scenes. And so when you explain that to consumers that it's not coming from the Wells Fargos, the Chase, the US banks, they're simply originators and servicers, which are 2 other pieces, obviously, besides the Fannie and the Freddies of the world that truly fund the money. Because they fund the money, they make the rules. They give us the books, or you can go online and look up the rules. And then any additional restrictions above and beyond those rules, and I'll explain why there is, are called the overlays. Okay, so
And
that's
each
right.
company will have their own.
That's right. Each company looks at the file. Now, the reason there's overlays is because we're all graded as companies, how our performance is, meaning how the loans pay back, what we originate, how it pays back is a reflection of us as a company. Even though we might meet the rules of Fannie and Freddie's and FHA's of the world, we still are graded on the performance of how they pay that back. And if it's not good, well, as a company, we start to lose eventually either pricing advantages or you could lose the ability to underwrite for Fannie and Freddie altogether if it got really bad.
And let's think about it. So Fannie and Freddie really is your conventional loan market,
Yes.
right? Where Ginnie Mae might be
Correct.
your government loan market, or be your HUD, right? So your Fannie Freddie is really primarily where 80 or 90% of all your conventional mortgages are going to fall at the end. So if you think about it, right, you've got, we'll call it AMIC. You might have a pool of money this big in your credit line or your warehouse line, right? You run out of money and you go, well, I gotta sell these off to replenish the money to do more loans. So perhaps somebody else buys it and they got a pool that big. And then at the end of the day, right, when Fannie and Freddie buy it, they've got a pool that big. So all it is sort of a recycle of money through the mortgage market so we can keep mortgages running, right? So, when you look at that, and just so you understand it, Fannie and Freddie, the primary buyers, not the only buyers, but the primary buyers of the secondary mortgage market, that's where all the money comes from. But how do they replenish their funds?
Well, they raise capital. They sell mortgage-backed securities on the Wall Street market. So that's basically compared to like treasury bonds or, you name it. They simply raise capital. And the way they raise capital is obviously by issuing a return. So part of that interest rate that you are charged as a consumer is to pay back the investor. And obviously if that percentage is not very good, the investor finds it more attractive. And we're talking big companies. We're not talking about typically your average individual. If they think that the stock market is doing very well, they'll put more of their money that route, which is why in turn you start to see rates climb because they have to attract investors back.
So what you'll see is there's a correlation between the stock market
Absolutely.
and the interest rates that the consumer is passed down because of that factor. Because they have to keep investors interested to invest in those mortgage-backed securities.
Yeah.
Because if they don't, Fannie and Freddie eventually run out of money. They can't buy the
And they have
loans.
to raise capital just
Yes,
like us.
they have to raise capital. So very confusing piece, but also the more you understand that, the more you can explain it, the more you get the whole picture. Now, with those mortgage-backed securities, right, this is part of what happened during the crash with those mortgage-backed securities. You ever watch a movie? What was it? Not Too Big to Fail, the other one. Yeah, Too Big to Fail. Is that the one? No, the Big Short.
I know what one,
right?
I was gonna say, I know what you're talking about, I haven't seen it though.
The
I
Big
have
Short.
not either.
Watch that movie because that thing will explain what happened so well and so accurately. But it's a wonderful movie. I bring this up only because I think when you understand how mortgages flow and you understand how companies create their rules and regulations and why they do, then when you go to one company and they say your buyer will never qualify for an FHA loan because of this, and that, wait a second, that sounds like an overlay. I'm going to talk to somebody else. I can't tell you how many agents have accepted that answer and have let a deal go by the wayside because they were told this can't happen. And truly it could.
Yeah, and it's, and with that, just to add, and again, what's nice about companies like ours is we have a lot of control over what our overlays can be. And for the most part, they're very, very minimal. So when, you're talking to, a lot of these millennials are starting out online, I would say by and large, probably most of them. And they go through and they get that quick approval and they go through, okay, so this is what we're qualified for. But you actually start diving into it and realize that, like you said, student loans. Well, there's a lot of ways you can go with student loans, or ways, if they're in a deferred status, you move them to an income-based repayment status. There's a lot of different rules that they have no idea could play a really large role in whether their approval amount is, how fast they qualify, how fast they close. But again, just that.
Let me just add a follow-up question to both of you guys here. So with that, because you brought up a good point, right? How things are interpreted. With a physical underwriter, and you'll see this between companies, even between underwriters, the way they interpret something like debt or income or, whatever the case might be, there can be differences on how they look at things and interpret between underwriters. So how do you know at the end of the day that when you go to sell that loan to Fannie or Freddie, you know, if it's Fannie Freddie Direct or any investor, that you are going to interpret it the same way they want to see it.
Oh,
Well, there's still a standard guideline. For
Yeah.
instance, with student loans, let's say, you know, it shows up as 20,000, the credit report doesn't have a payment, which happens all the time. We can use 1% of that. They can produce a statement saying that they pay less, then we would use their statement. So there's still a guideline in place.
Let me reframe the question. Let's talk about self-employment income.
Okay.
Multiple companies, let's say I own 4 different companies, my income statements and my profit and losses, my taxes are, you know, there's things going on that are just crazy. This is where I've seen this, where underwriters will interpret things, incomes and assets differently. So at the end of the day, you know, how do you deal with that piece on a complicated, you know, borrower that way?
so, I mean, if we've underwritten and funded ourselves, are you saying what happens after
Yeah,
that?
are you worried about, you know, like they'll
Sure.
reject the file and
Oh.
how do you buffer against that?
Okay, so I mean, obviously there's risk, and as mortgage companies, and you know, you become corresponding, you start to underwrite everything in house. That's a risk you take. I mean, there's benefits, obviously major benefits, but there's a risk, and it's called buybacks. So if you do underwrite and fund a file that Fannie or Freddie or whoever the investor rejects, you are stuck with that file. That is yours. So there is that layer of risk.
Yes.
And you know, just like government, Fannie and Freddie are no different. They leave a lot of their rules up for interpretation. And if your underwriter interprets it one way, they interpret it a different way. At the end of the day, you know, they won't buy it.
So that's how important the right underwriter is.
Yeah, that's a
Yeah.
risk. But you know, that's the nice thing is, you know, when you're a bigger company, you know, that's all built in as part of your, you know,
Yeah,
Your buffer.
your
Yes,
portfolio. That's
yeah.
right. I mean,
Right. you know you're gonna own a certain percentage.
that's right.
Yeah.
And no
Yeah.
matter what, at the end of the day, there's going to be buybacks.
Right.
Now, to the consumer, it changes nothing. In fact, it might actually benefit them, because usually when there's a buyback, it's because maybe we missed out on incomes with buy the loan down to be able to sell it to a different servicer. So usually the consumer actually wins if that actually happens, because the terms cannot get better or worse.
Yeah.
It can only get better if they choose to.
Gotcha. So, all right, well, that, guys, about concludes our time. At home, for those listening at home, any questions or follow-ups before we let out for the day? We'll give them a second to unmute themselves. If they can figure that out.
Yeah, you probably scared everybody.
Probably did.
Real quick, a sidebar, when we were talking about, you know, servicing and selling and that, and consumer perception and things like that, how the market works. Still to this day, I see consumers and people in our industry, when the feds raise prime, that has nothing to do with mortgage interest rates. Prime is credit cards, car loans, bank lending, and people
HELOC lending
panic.
too, though, correct?
Pardon me?
HELOC lending too, like secondary, like second
Like
mortgage.
an unsecured,
Yeah, yeah, okay.
So people still panic, like when they've got a mortgage application in process, and, you know, they think that the rates are gonna go up when they start to hear feds talking about raising prime. It does not affect mortgage rates, so there's still a lot of confusion
Yes,
in the
yeah.
industry on that.
Well, it looks like we have no questions at home. How about you guys?
I'm good.
All right.
We answered
People
everything
loaded
before
up
you even
brain.
thought about
Yeah.
asking.
I got.
One
You got
step ahead.
everything you ever want to know about mortgages, you now have in your head. All right, that's it. I'm gonna figure out how to shut this off. I have no idea. There we
Well,
go.
thank
Stop
you.
recording.
Yeah.
Thank you, everybody.